Hi, everyone. So sorry about the late start. Had some trouble connecting on my end, but happy to get started. All right, so today we're just going to do a continuation of the series that we've been working on, which is just an introduction to options. So we're going to talk about options pricing today. Give me one moment and I will go ahead and share my screen. All right, so let's talk about it. So we're going to talk about getting started with options, and we're going to focus on options pricing. So this might have been something that you've attended before, or you might have seen this before. Either way, it's a really important discussion where we go through how an option is priced, how it's comprised, and ultimately it sets the foundational aspects that is for the options Greeks, even for the advanced stuff. Understanding options pricing is ever so crucial. If you don't know me, Jessica and Skip, I'm the Director of Education over here at OptionsPlay. And of course, before we get started, always have to start with a disclaimer. Know that types of securities forms and research tools used in this video are for demonstration purposes only, should not be considered by recommendation for OptionsPlay. OptionsPlay is a third party that is not affiliated with First Trade. So any opinions or recommendations or any securities that you may see on your screen are purely for example purposes and do not constitute a reflection of First Trade in the slightest. Know that this is purely educational. Options are complex. They require a separate approval. There's a document called the ODD, which is the Options Risks and Disclosure document that you can find on the OCC website and all over First Trade's website that essentially goes over the characteristics and risks of options because they are complex and essentially not for everyone. So we start to read that, but know that today is largely educational and a lot of information that is found within that document. Nonetheless, let's go forth and talk about options pricing. So what we're going to learn today is we're going to talk about the anatomy of an option. We're going to look at calls versus puts. We'll look at what comprises an option's premium, intrinsic value versus extrinsic value, which is an option's premium. Of course, we'll have some examples and save some time for Q&A. So going through what an option is essentially a contract between a buyer and a seller. If it sounds like there's a lot of legal jargon, that's because there essentially is. It is a contract with terms associated with it. If you are the buyer of that contract, you're the one who owns that contract, which means you can execute upon the terms or the rights contained within that contract. The seller, who's someone who sells you that contract, a lot of times an analogy that's commonly used is a coupon that they are obligated to fulfill the terms of that contract. So from the coupon perspective, if you have a coupon to buy cereal for $1 off, the person who gave you that coupon, or maybe it was sold to you for some way, shape, or form, they are obligated to fulfill the terms of that. And think about what that means in context of options is they don't necessarily want to fulfill those obligations. Remember that when we're thinking about what is our driver or our incentive for trading options, you always think about it in the buyer's perspective. And when you lay out, does it make sense to execute upon the terms of the contract? Or a lot of times we get questions on how do I understand if I'm going to be assigned? It's all on the view of the buyer. Does it make sense for them to exercise the rights that are found within that contract? If it does, then your likelihood of assignment is higher, not necessarily guaranteed, but likely higher. And we'll talk about what all of those terms mean as well, because this is largely introductory. But what I want you to take from that is a buyer pays for the contract, which means they want the contract to go up in value as much as possible, whereas the seller receives a premium for that contract, they get it, and they, on an individual basis, just do not want that option to have any value whatsoever. The contract is then issued as a call or a put, and all that simply means is a call contains the right to buy and a put contains the right to sell. So I want you to think about these terms anytime you hear an option. Anytime you hear the word long, you should think about purchased. Anytime you hear the word short, you should think about sold, and then put that all together with calls and puts. So if I hear long call, excuse me, when you say call, I want you to think of the right to buy and put the right to sell. The is very important there. So when we say long call, that means you've purchased the right to buy. We have a short call, that means you've sold the right to buy, which is you don't want the right to buy to kick in, right? And if you are long a put, then you have purchased the right to sell, or if you're short a put, then you have sold the right to sell. So those are just good terms to keep in your mind when you see long and short versus call and put. That helps really put the options puzzle together. Now, I do have some terms within this contract and this visual. Oops. My mouth is really sensitive. I apologize. But the contract is normally executable at any time and through the expiration period if it's issued as an American style contract. And this contract represents 100 shares of ABC at $100 per share. So that means if this was a call, the buyer would have purchased the right to buy 100 shares of ABC at $100 per share at any time through the expiration period. If this was a put, the buyer would have purchased the right to sell 100 shares of ABC at $100 per share at any time. Whereas the seller just doesn't want it to have any value. So make sure you keep that in mind. Moving on, and really a summation of going through the details of the contract is, with every contract, we ask ourselves some questions. What quantity are we agreeing on? What product and what price and what time frame? Those are all just terminology that we use. So the quantity is the contract amount. One contract generally represents 100 shares. The product is simply the underlying security, and that could be a stock, an ETP, which is an exchange traded product, which could be a fund, which we're all familiar with, or perhaps a note, an index currency, or even a commodity. The price is simply the strike price. So the agreed upon price is the strikes in that previous example, the $100, and it is priced per share. So one contract represents 100 shares. So when we say 100 call, we mean the right to buy 100 shares of whatever product is priced per share. So we always multiply times 100. The time frame is just simply the expiration date when the contract is good for, normally on Fridays, but now there's contracts expiring every single day, depending on how much volume is found within those options. And the quantity, here's your example, 1 ABC 100. Sorry, I did not update these dates for you, but let's assume this is 30 days from now. We have 1 ABC 100 July 29th, 30 DTE, days until expiration. You see that acronym quite a bit. That simply means that this represents 100 shares of ABC stock at $100 per share expiring on the expiration date. And again, I apologize for this typo here. They should say the same, but let's pretend that this is the same date 30 days from now. It is then issued as a call option, which is the right to buy, or a put option, which is the right to sell. The option can be exercised, which just simply means you execute upon the terms of that contract. So if I had a call and it had the right to buy 100 shares of ABC at $100 per share, then I would, to literally execute, is I would receive those shares in my account and buy 100 shares of ABC at $100 per share. That's the exercise process. It could expire because it has an expiration date. So unlike a stock, an option will cease to exist. It will eventually not be worth anything because, like a coupon, it's got a good until date. And you can't go to the clerk and say, hey, can you recognize that? It does not work that way. Or they are traded, which is the more common use of options on the secondary market. And they are traded for what's called a premium, which is the bulk of what we're going to talk about today. So here's a little chart you might have seen before that here at OptionsPlay we talk about quite often. It's a T-chart where we put calls on the left and puts on the right. We start with long calls on the top. And again, this is where I want you to think of, I've purchased the right to buy. When you purchase an option, you purchase it for a premium and you own that right to buy. You can execute upon those terms. If you're a seller, or if you're short a call, you've sold the right to buy. So you've received a premium and you're obligated to fulfill the terms of that contract, which means the long call holder can execute upon the terms, buy 100 shares of ABC at any time. Someone has to be on the other side of that transaction, and that is a the seller or the short call holder. They would sell you those shares at $100 per share. That is important to know. A short call is on an individual basis, the only contract with an unlimited risk potential. Because think about that. When are you only going to execute upon the terms of the contract? When it goes up in value. And when the stock can theoretically go to an infinite price in value. So if that ABC example, you have the right to buy at 100 and all of a sudden it's at $200 per share, $300 per share, that's an extreme example. If you don't own that 100 shares of that security already, in order to fulfill your obligation, and mind you, you may not know when that's going to happen because you are required to fulfill your obligation at any time. If that occurs, you may have to buy those shares at an astronomically high price, which means this does have unlimited loss potential because of the obligation that's out of your control. Whereas a long call has limited loss potential because you own the rights, you paid that premium. You don't have to execute upon that right if you do not want to. Entirely your choice. There are auto exercise and things of that nature, but that is a different presentation that we will talk about. Then we put puts on the other side, and we put buyers on the bottom right quadrant. So when you are long a put, that just means you've purchased the right to sell. You own the right to sell. Therefore, you can fulfill the terms of that contract. And then the inverse is true for the short put. So this is a really helpful chart, especially if you're just learning options. We build on this astronomically, and we love to teach by saying there are certain strategy drivers. And they all start with knowing these 4 individual legs inside and out. But before learning these 4 individual legs inside and out, you have to focus on a long call. And you can utilize this chart to really understand the individual legs because everything's essentially a mirror. So we have bearish strategies that are at the bottom, and you'll notice that there's either an obligation or a right to sell involved with bearish strategies. And then with bullish, we have the right to buy or an obligation to buy the bullish strategies. So this is the way that you can think of everything. If I'm buy a call, I'm bullish. If I'm short a call, I'm bearish because I don't want this to have any value. That's it. I purchased something I want to have value. If I sold it, I do not want it to have any more value. I want to sell it at the high, right? And if I'm purchasing a long put, I do want that to have value, but because it contains the right to sell, the value comes when the stock goes down, the underlying security goes down. Then the inverse is true for the short put. I don't want the stock to go down, which means that long put's going to have value. I want to keep my premium because I sold that for a premium and I am selling at the highest price or attempting to, and I do not want my obligation to buy to kick in. So therefore I'm bullish. So a good way to think through everything is there are relations with options and certainly risks and benefits with all of these. And the key is layering it, understanding risk versus reward. But today we're focusing purely on the educational aspects of how an option is priced. You just want to make sure you have the tools to think through this. And from going forward, we're going to focus purely on a long call. And if you want to understand how it works from the other perspective, then this chart is very useful. So let's go back into how an option is priced. So a premium is comprised of intrinsic value and extrinsic value, 2 components. Within those 2 components, we break them down into 3. So intrinsic value means in the money. It has executable value. As a term you hear all the time. In options, we'll say, oh, this contract is in the money, or it's at the money, near the money, out of the money. All that means is in the money is it has some value. It has executable value. It's near the money, close to it, at the money, identical. There's no executable value at that point. And out of the money, 0 executable value. It's not in a favorable position comparative to the market price and the strike price. So in this case, for that example of a long call, that means if your underlying security moves above, if you have the right to buy at 100, and then your underlying security is 105, that's in the money. It's deeper in the money if it's at 110, and you can see how that trend continues. But this is an option, and it has more value comprised than the underlying security. There are other components. One, which is time value, and the other, which is implied volatility. So let's think about time value. We have expiration dates that are issued with options. Since there is a expiration date attached to that, you are more likely to have your option go up in value the longer the expiration is. The more time you have, the more expensive generally that an option is. So, but we of course can only move one way in the sense of time. So therefore, as that option decays or nears expiration, this is something that is a decaying factor. So an external factor. And implied volatility. So the textbook definition of that is the market's forecast of a likely movement in the underlying security in either direction. A really great example is earnings announcements. Think about earnings. You have a expectation that analysts have set for a security, and then they give you two pieces of information that will help us understand if it's better than or less than the anticipation, which of course is the EPS that's reported, the revenue that's reported in forward guidance. But there's a lot of volatility that leads up to that because we know that the stock is going to move a lot or very likely to move a lot in either direction, depending if it meets or exceeds or doesn't analyst expectations. And we call that implied volatility. And normally when that occurs and we get our earnings expectations, the implied volatility component of the option contracts and decreases, but it can also increase if you expect implied volatility to increase. So think about the broader market. There was a lot of volatility, I'd say, more so leading into yesterday with Powell's comments. And that's because we weren't sure. There was more data coming out. How is he going to interpret it? So that's an increase in implied volatility. And that might have affected options that you've already owned because the market was expecting a movement in either direction. In yesterday's case, it was down, but that was an unknown. And that is implied volatility is an unknown movement, but it's an expectation of movement. And with uncertainty comes volatility. And we know that with the market, and it translates into options. So the way I like to think about this is intrinsic value is really internal factors that affect the options price, and extrinsic value is really external factors. So let's build on the example. Let's say we've got ABC that's trading at 103, and we have a call that has a $100 strike price expiring 30 days from now with a premium of $5. So remember, this means the right to buy 100 shares of ABC at $100 per share within the next 30 days. So let's bring back up our premium, intrinsic, and extrinsic value. So if we have the right to buy at $100 per share and ABC is at 103, we can immediately execute upon the terms of this contract, buy 100 shares of ABC at $100, then sell it at the market for 103. The difference of those two becomes the intrinsic value. That's the executable value within this contract. Now, this goes back to my previous statement where I said, you may not necessarily execute upon the terms of that contract. And this is because pricing, there is so much more to an options price, and that's extrinsic value. You could sell this on the market for $5 rather than making the $3. So there's a difference of $2 there where it wouldn't make sense to execute upon the terms of this contract at this time. And that's because there's extrinsic value. Extrinsic value, in its simplest terms, is just the excess amount beyond its intrinsic value. And remember, intrinsic value could be zero. If this was at, the strike price was 105, your option wouldn't have any intrinsic value or any in the money value. It'd be out of the money because it makes more sense to buy stock on the market rather than the terms that the contract contains. So going back to extrinsic value, we just simply take the premium, so where it's trading at, minus the in the money value. The difference of those two becomes extrinsic value. And there is our two components that make up our premium. So let's dive a little bit deeper into that. So let's say we've got ABC at 105, and we've got an options contract with a 95 strike, expiring 30 days. Got really ahead of myself there. Sorry about that. We've got a last price of $12. What's the intrinsic value? If I've got the right to buy at 95, can immediately sell at the market 105, has to be 10. And if the last price is 12, the excess, of course, is 2. Then if we have the same days until expiration, but now let's go up $5 in strike, that's trading at $8. The intrinsic value is 5 because I can exercise on my terms, buy at 100, sell at 105, that's $5. Then the extrinsic value then is 3. So the difference of that creating our last price of 8. Then if we have an options contract at 105, so this is the same as the last price. So now this is an at the money option. We don't have any intrinsic value, but we only have extrinsic value. So this is our first at the money option that I'm showing you, which is when executing on the terms of our contract versus buying the shares of ABC on the stock market or on the secondary market are equivalent at this point. So that's considered at the money, which means the entire price is extrinsic value. Now we have an out of the money option, 108. So exercising with our terms to buy at 108 versus the market price of 105. The market is a much better price, so therefore it's out of the money. That last price is 4, as is, my mouse is so sensitive, apologies. Therefore, it's purely extrinsic value. Now you might have noticed something here, and I certainly hope you did. All of these options have the same 30 days until expiration. And the option that is at the money had the highest extrinsic value. And that's true because extrinsic value tends to be centered around at the money options. And that is mainly due to implied volatility, because think about that. When you are more likely, when you have an option that is near or at the money, so 105 and 105 in this case, this just has to move a penny to be in the money or a penny to be out of the money. So there's a lot more action there, if you will. Pulling up the OptionsPlay tool, I like to use this as just an example, a real life example. We've masked it to say ABC, but maybe you could figure out what it is. But essentially, just showing you the differences of in the money, at the money, and out of the money options examples. If you have the in the money option, so this is the strike of 150, the in the money value is the 773. The remainder 327 is its extrinsic value. The at the money and out of the money have no intrinsic value. This is all extrinsic value. And you can see that this holds true, that the 450 at the money option has the highest extrinsic value. And it's important to know because a lot of times people will say, oh, this is the cheaper option, the 165, but it has a longer destination or a longer journey to actually have value. This is a shorter journey to have value, and this one already has value. Keep that in mind as we move through this series. So let's dive deeper into extrinsic value and think about the time components. So ABC 105. Now let's look at the 100 strike 0 days until expiration call that's trading at $5. That, of course, has purely intrinsic value and no extrinsic value. And that makes sense. 0 days until expiration, time's run out. We've run out of time. We have an ABC, same strike, 30 days until expiration, trading at $8. Well, that's got the same intrinsic value and extrinsic value of $3. 45 days until expiration, same strike price. I hope you see the pattern here. Intrinsic value is 5, extrinsic is 4. And let's go out 60 days, trading at $9.50. Intrinsic remains the same, and extrinsic is $4.50. And you might have made another observation here. Every option does have the same intrinsic value, and that makes sense because they have the same strike price. But time value, it didn't move equally. We went from 60 days to 45 days and only moved 50 cents. But when we went 45 days to 30 days, we moved $1. And then when we moved 30 days to 0 days, we moved a whole $3. And that's because time decay is not linear. It actually depletes really quickly or more quickly the closer we are until expiration. And that's important to know with the way that options react. So another reason to keep in mind, just understanding how an option is priced is just so essential in the first step. We even say after you watch you're still not ready to trade options yet, because you have to understand the components, but then we have to also understand the strategy behind that. To complement it, if you will. Bringing back that OptionsPlay screen, just to show you again here, we've got a 2 days until expiration because the screenshot was not taken on that expiration day, 30 days and 45 days, and you can see how that holds true. This is the in the money value is consistent with $8, but then your extrinsic value, you can see as it really just decays the second it gets closer to expiration, and that's important to know. Which means when we buy an option, we buy time, and we need to make sure that we understand that we want time to move in our favor, understand those components, which again requires another presentation. All right, so then I'll take you through one more quick example. So let's say we placed a trade and ABC is at 105 per share, and we have a strike price of $100 with a 30-day expiration period. The way that would look like is we would buy to open one ABC 100, 30 days until expiration call, and let's say it's trading at $6 per share. The intrinsic value is $5. The extrinsic value is 1. That makes sense from what we went through. We have the right to buy at 100. The market's at 105. So that's worth 5. $1 is the extrinsic value. Let's say we get all the way to the expiration date. And this is assuming we hold it till the expiration date, which you do not have to do. Keep that in mind. So now let's say an expiration day that ABC is at 110. That means that option value has $10, which is fully intrinsic value. You still would have made $4 per share. Remember, the stock market certainly moves in waves. So building on, let's say ABC is at 105 and it stayed the same. Well, our option value would only be worth its intrinsic value, 0 extrinsic value. And that's because this depletes. In both situations, we lost the extrinsic value. We gained a little more intrinsic on the previous. We have a loss of $100 in this scenario. Let's say we were completely wrong in our sentiment, which happens, which is why it's important to have an exit strategy, and ABC is at 95. That has 0 intrinsic value and 0 extrinsic value. In this case, we would recognize a full loss of the $6 per share, which is $600 total. All right, so I will leave it at that. Next week, we are going to focus in a lot more detail on long calls and long puts and moving into that strategy perspective. But the goal of today was really for you to understand how an option is priced and know that there are other factors that affect your options premium aside from the underlying security. And those other factors are implied volatility and time value. Interest rates and dividends do have an effect as well. We certainly appreciate you taking the time to invest in your education. That's extremely important. And we encourage you to join our next session, which will be 2 weeks from now. But thank you again. And I hope everyone has a wonderful day.